Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hope all of you had a very beautiful day of trading today. And in today's price action, guys, well, we had a nice little bounce recovery after yesterday's sell-off action, but I would not say that we are out of the woods just yet. Yes, the SPY still maintaining this very tight range at the top. As a matter of fact, today's price action was all within yesterday's candle, and on the QQQs as well. Even though the QQQs were up almost 1% today, still not enough to clear the price action of yesterday, and that is in spite of Tesla's 20% gain benefiting the QQQ very heavily today. So in today's video, guys, we're going to cover a few things together. Number one, I have a few earnings prepared for you guys, and that is going to be UPS to start it off. And then second, a company that is not on this list at all, but is still very worthwhile to analyze, and that is going to be SPGI. Company that doesn't get talked about very much, but is one of the strongest players in the entire stock market. So we're going to be covering those two earnings very shortly. Thereafter, we're going to do a major rundown of our technical analysis on the major stock market indexes, followed by our big tech names, see if there's any opportunities to be had there. And lastly, take a quick glimpse into my portfolio for a few of the trades made today and what I have left for the week. So without further ado, guys, a lot to cover today. Let's jump right into the action. So the SPY up a very nice 0.22%. The QQQ's up a very nice 0.81%, and overall today was a much more broad market recovery than we've been having the rest of the week. The rest of the week, whenever we would have a little bit of sideways action on the S&P, the entire bottom half of the market was red, and the only pieces of the market that were leading us to the upside were big tech. Now, today was a lot more balanced of a market, but still we did have a few pain points. So big tech doing well today. Financials, once again, very mixed. Healthcare is still on a decline, guys. For the past 3-4 weeks at this point, healthcare has not been doing very well, and that price action continued to the downside today. The outperformer, of course, Tesla, almost up 22% on the day. And the bottom half of the market here, guys, industrials, real estate, energy, things like that, those were all to the downside. So what does it leave us with? A very mixed market picture, not only for the day, but also for the past week of trading. On the one-day relative, the best beneficiary of today, consumer cyclical. That is fairly obvious just because of Tesla's weight in that subsection of the market. And also your Amazon coming up nicely by about almost 1%. So they were the outperformer. But as you can see, guys, the rest of the sectors very mixed amongst each other. And on a 1 week relative as well, very mixed market. But as you can see, a lot more red than definitely we had green. So still in daily consolidation, still also in weekly consolidation for the markets. And this just continues to be, especially this week and into next week as well, it will continue to be a story all about earnings. All eyes will be on big tech earnings coming into next week. And the following week thereafter, we get the Federal Reserve interest rate meeting, which a lot of people are saying is supposed to be a 0.25% cut. We will see exactly what happens. As we always do on the channel, guys, we'll take it one day at a time. So before we get into more technical analysis, let us dive right into some earnings, and we're going to cover UPS to start it off. So UPS coming on today, having a very nice gain, about 5.28% to the upside, but at one point today, UPS was up almost 10% before retracing a little bit, giving back those gains. But their earnings report was very good, guys, and they really needed it because we know that for the past 2 years, UPS has been on a steady decline as they struggle with their average package volume per day on a decline, getting squeezed in their margins as well. So we've been looking for the turning point in the cyclical nature of this business. Is it here? Well, let's have a look. So in terms of the numbers, beat on the bottom line EPS by about 8%, very healthy beat, and beat on revenue by just shy of 0.5%, but still, double beat right here for UPS, and they did increase guidance, and that was an important factor. So UPS tops quarterly profit estimates on rebounding volumes, and the shares jump. Let's get into it. Benefiting from rebounding volumes and effective cost controls is UPS. We've been talking a lot, guys, because I've been covering these earnings for UPS pretty much over the past 4 or 5 quarters every single time. And we've been saying that even though their average daily volumes were coming down, the company was doing an amazing job in cost control, controlling what they can control, right? This business is obviously a cyclical business. It goes up and down with the economy, and of course is a very heavily consumer-facing stock. So it stands to argue when consumers have a little bit less money, they tend to not pay for priority shipping, and as such, UPS doesn't make as much money to their bottom line. But in the process, they've been doing a very good job of controlling the costs that they can control, right? So moving on. The company also raised its full-year adjusted operating margin forecast, and that's an important part. We'll get into their margins a little bit later. UPS has been seeing volume growth in the US since May, following 9 quarters of weak demand after pandemic-induced lockdowns ended and inflationary pressures crimped some e-commerce purchasing. Its third quarter domestic volumes grew 6.5%, finally growing its domestic volumes. A large portion of the growth has been driven by new e-commerce entrants identified by industry experts and shoppers as bargain retailers Shein and Temu. This has exacerbated the shift from premium air services to less expensive ground services, and then to the even more low-profit SurePost services, where UPS picks up packages and hands about 60% of them off to the US Postal Service for final delivery. So not a lot of money, guys, in that end mile delivery, right? Which is what Amazon keeps saying every single quarter. Not a very easy business, that last mile delivery. Now, the company had slashed its full year adjusted operating margin target to 9.4% in July, despite an uptick in US volumes because of the shift. This shift, right, to lower margin volumes. It now expects a full year operating margin of 9.6. So besting their already sandbagged guidance, in other words. UPS seems to be controlling what it can at the late stage in the cycle. The improved margin forecast points to cost cuts outweighing lingering macro headwinds, and that's important. Posting a solid, nearly all-around beat after 2 years of misses and lowers will confirm the view that fundamentals and stock price have bottomed. UPS has been onboarding the USPS air cargo business, which it took over from rival FedEx after its contract expired on September 29th. UPS expects the 5-year USPS contract to be profitable in the first year. FedEx, guys, contrary to UPS, was really struggling with profitability in the contract that they had with USPS for the last roughly 3 to 5 years. So nice to see that UPS is able to better service the United States Postal Service in terms of not only for themselves, but also as a whole in terms of profitability, right? So looking not too bad for UPS. And one slide that I want to bring your attention to across the earnings slides, because yes, I do look at every single one and I kind of pick which one I think is the most noteworthy. Here it is, guys. Finally. Daily volume increases 6.5% year over year. You can see here is your calendar graph, right? You can see what a struggle it was for UPS. The bottom line here is 2023 was not a good year for them. And even into early 2024, guys, we were still negative in terms of volume growth. Happy to say that now in the most recent quarter, the last 3 months, the growth is now back. So as the analyst was saying in the article down here, fundamentals and stock price have quite possibly bottomed. He said it as an absolute, but on the channel here, we like to keep an open mind for either or direction, stay objective, right? But as a whole, this is kind of what I was talking about the rest of the week with semiconductors and other companies as well that have a bit of a cyclical nature. The art of finding the bottom of these guys is finding the turning points in the data that matters the most to the company, which is your average daily volume, which is why I thought it would be important to bring up. Here's a story of UPS profit margins. As we can see, coming off of 2022, you can see there is a bit of a problem here. Operating margins dropping off a cliff and net margins as well, pretty much going back in half. And there's a very easy explanation for this, guys, right? Well, UPS is obviously a very capital intensive company. It has a bunch of trucks to service, right? Planes, warehouses, a lot of employees, and all of those are relatively fixed costs. You can't eliminate more than you can until the business starts to really falter on its operating mandate, right? Until you start really ruining the business's ability to operate full steam ahead type of thing. So when you have revenues that are declining and you have fixed costs, the best you can do is try to control your variable costs, right? All the fluff costs in the business that you can possibly do away with. The company's been doing a great job at managing those, those fluff expenses, so to speak, and they've been bringing down those variable costs as much as they can. But the fixed cost portion of the business remains. When you have dwindling revenues and fixed costs, your margins get squeezed to the downside, guys. So now, as we can see, this chart does not reflect the most recent operating margin that UPS posted, but when we see it next, this will be starting to trend to the upside, which is exactly what we want to see for UPS. Now, in terms of the fundamentals of the business, guys, I've always been a fan of UPS for a few reasons. It has a very solid dividend at the current share price, guys. Almost 5%. And they're also a very good they're a company that provides a lot of free cash flow. And what do they do with the free cash flow? Well, not only do they pay that dividend, but they also do a ton of share buybacks. here is your shares outstanding for the last roughly 15 years. And you can see that although they stalled when the business started to, turn the corner after the boom of the pandemic, it did stall a little bit, but now they've been resuming these buybacks over the last roughly 4 or 5 quarters. So not too bad. Profit margins should be coming to the upside once again. So that aspect of the business is good. In terms of the growth of the business, well, the growth has never been a problem. We know that the business is cyclical. Here is your post-pandemic boom when everybody was ordering everything online. Here is the cyclical nature of the business coming in, the post-pandemic slump. And now we are starting to resume a new growth cycle for UPS. That is your EPS for UPS, and that is their EPS. Now moving into revenue as well. Same thing, right? Revenue cyclical decline after the pandemic boom, and now we are supposed to be accelerating revenue to the upside. So the growth forecast for the business does look good, and most analysts, except for 2 guys down here, all have the business as either a hold or buy ratings with price targets largely at the current price, around the current price, or decently above. Now, in terms of the actual valuation here, let's have a look, right? So revenue growth of about 4% per year. It's never been a crazy top line growth revenue. At best, they want to retain their market share and slowly increase it. We see that in a lot of different businesses, such as Costco as well, right? In terms of EPS growth, well, EPS growth is very, very, very solid here, guys, right? So EPS growth about 14.5% per year. That is fantastic. Gives them a valuation P ratio of about 18.2. That is not so bad, just at a face value. When we divide this by their EPS growth rate, we get a PEG ratio of 1.26. I'll remind you, anything under 1 is very good. Between 1 and 2 is okay, but you want to be closer to 1, and over 2 is a little bit expensive. This ratio allows us to compare many different companies in many different industries amongst each other and figure out how much are we paying for the next 3 years worth of growth for any company. So you want this ratio to be closer to 1. 1.26 is very good. And the standout here has to be the free cash flow yield at almost 4.1%, guys. This is really, really good. Usually I look for free cash flow yields between 2.5% to 5%. The higher the better, of course, because the higher it is, the more money they can return to you as a shareholder in the form of dividends or share buybacks. So to see them at 4, it's closer to the top end of what I look for at 5. This is a very, very, very solid number. Just goes to show, guys, the stock has been on a significant decline. So these metrics are now very, very solid. In terms of the technicals, I've always liked this trade, guys. You've seen me play this one a bunch of times in the past 2-3 months in the lower 130s down to roughly low 120 area. I think it's a very juicy area of technical support, previous resistance from 2018, 2017, and now current support level for the stock. And with today's price action, we are now embarking on a possible new weekly uptrend. We really have to get out of this downtrending channel that we're in right now. You can see we kind of, sorry, something's itching. So you can see that we are currently trying to break out, but the candle did not close, but it looks pretty good on the daily as well, right? Daily looks kind of good. We got back a few levels, closed the gap from last earnings as well. And now they have a lot of space, guys, to set up for the daily. Well, now it's going to look like this, right? Daily higher low for the possible trend continuation into the 140s. So moral of the story, I still love playing this stock with short puts down here, but it also could be a very interesting swing trade, a bit of a longer term swing trade as UPS embarks on its recovery story. We're not expecting an NVIDIA rally like this, but a slow and sustained recovery while paying a 5% dividend sounds like a very decent longer term swing trade to me. So I do like this company at the current price level, and that is pretty much everything we had for UPS. Now, moving into earnings number 2, we're going to cover a company that rarely ever gets any media attention or attention as a whole, right? As a matter of fact, you saw it's not even, guys. It is not even on the earnings calendar, which is this one from Earnings Whispers is probably one of the most used calendars out there. I'm sure it's on different earnings calendars, but it's not on the main one, right? Just goes to show underappreciated. But look at this stock over the long term, right? Extremely solid company, $155 billion company. What does SPGI do? Well, good question. So it's a very diversified business, guys. They do a couple of different things. They have a ratings agency business to rate company debt, government debt as well. So that is a very big portion of their business. And this part of their business is almost a de facto monopoly. It's actually a duopoly with another company that you guys may know, Moody's, right? So here's your market share by player. S&P Global has 40%. Moody's has the other 40%. Fitch coming in slightly significantly under that at 15%, and your private rating agencies are about 5%. But you can see the domination is really between the two largest players in the game, SPGI and MCO, and both of their charts on the long term, on the monthly, they both look like this. Extremely high quality company, guys. Not only do they have the debt rating agency business, they have an analytics business too, where they sell financial data about companies, about commodities, about fixed income securities as well. Very large analytics business, guys. And as a matter of fact, you may see these companies post a few things, right? Today, we actually got an S&P Global Manufacturing PMI. Well, the data comes out of this company, out of SPGI, right? And then they also have the indexes business. So the S&P 500, that is owned by SPGI. And they also own, in a majority stake, about 77%, they also own the Dow Jones. So any single ETF that's based off the Dow Jones or based off the S&P 500 in their suites of ETFs, well, they collect that very juicy management expense ratio, and they really don't have to do much to it at all. So it's a very high profit margin business, guys. Look at these net profit margins, always in the mid to high 20s, all the way up to about 30%. And these past 2 quarters have been no different, high 28% margins. In terms of their growth, let's just go through this very quickly. You can see all the analyst price targets are above. EPS, consistent and profitable. Revenue, consistent and predictable as well. This is why this company is one of the best in the world, guys. They have a de facto almost monopoly on several things that they do. Very high quality profit margins as well. And it's just a business that kind of runs on autopilot at this point. So let's get into a bit of the details surrounding the earnings today. So you can see their earnings. As a matter of fact, SPGI was actually down today despite having a double beat and a guidance raise. Take a look at this. Beat on EPS by 7% and a beat on revenue by about 4%. Now, this happens to SPGI every other quarter, to where you're rarely expecting any nasty surprises out of this company because it's so consistent and so predictable. That being said, they are down about 3.5% today, but not because their earnings aren't good. This is why I say sometimes, guys, the earnings are a little bit of a casino. A company can post fantastic numbers on par or besting the analyst expectations. They can even raise their guidance and still the stock will drop. So let's take a look here, see if the drop was warranted. So as we can see, earnings beat, they boost their 2024 outlook, they commit capital returns amid a leadership shift. So S&P Global's Q3 sales surged 16% year over year, beating estimates driven by ratings and indices growth. So apparently something went wrong right here, but I wanted to show you the outlook. We'll get into the slides thereafter. S&P Global raised its full year 2024 revenue outlook to 11.5 to 12.5%. That is over the consensus estimate, the prior guidance of 8 to 10%. So they raised it literally by almost 2%, guys, for the revenue and also the EPS. Look at this. They raised their EPS, so their bottom line profitability, to $15.10 to $15.30, up from $14.35 to $14.60. That's roughly a 7% raise on EPS bottom line guidance. Fantastic earnings from this company, guys. There's literally nothing wrong with this earnings result at all, which is why it's so funny to me when these stocks like this, and even Moody's, we'll do Moody's tomorrow, but Moody's the same thing. They had amazing earnings the other day, and the stock was down roughly 4% after that, right? So that's just a byproduct sometimes of earnings. The price action after earnings sometimes is a little bit strange and difficult to comprehend, right? So let's take a look at exactly the elements of SPGI's business and see if we can find anything wrong with the company, right? So here's your build issuance. So this is pretty much your ratings agency business. Take a look at this massive jump from Q3 last year into Q3 this year. Build issuance is up 76%. Now, this makes perfect sense, guys. Keep in mind, we are coming into a rate declining cycle. So every single interest rate decline is going to require a re-rating of either corporate debt or government debt as well. And SPGI and Moody's are going to be there to get all those juicy fees from companies who have no choice but to re-rate their debt progressively to be able to access capital markets. So this division of the business is definitely not lacking for them at all, right? Take a look right here. Here's their market intelligence division. 6% revenue growth in the Q3. Very, very nice. And look at these operating margins, guys. These operating margins are extremely good for all of their businesses. Ratings business, what we just touched upon, 36% growth year over year. Commodity insights, which is also market intelligence, but this time for commodities, 9%. And S&P Global Mobility, which is a little known segment of their business, is actually new within the last 2-3 years. is about, it's all about the auto industry. So tons and tons and tons of financial analytical data on the automotive industry. What are the trends right now? Which cars are selling the best? What's the average MSRP, right? What is the average salary of each person depending on the car that they choose? All of these deep insights into the automotive industry. It's a small portion of their business, but still a growing business nonetheless. And your S&P Dow Jones Indices business, where they just collect those juicy management fees from the ETFs, well, that is up 18%. So where in this report can we possibly find anything wrong with the business? Well, the short answer is we can't. They literally beat on everything. Every single line of business is expanding very nicely. As a matter of fact, they beat over the analyst consensus and they even raised their guidance. So there's really nothing bad to say about this here. You can break this down any single segment, guys, and you will see that every single segment is growing as it does every single year. So that's pretty much the fact of the matter for SPGI. They reiterated as well. 2024 billed issuance growth is going to be 50% year towards the year end. And thereafter, 2025, 2026, as we progressively move through the rate cutting cycle more, this billed issuance is going to get even better and better, in my humble opinion. So here's the guidance raise. Once again, no secret there. The revised outlook for a lot of their lines of business, right? You can see they tapered back a little bit in terms of market intelligence, but look at this, right? Revenue outlook, previous outlook for the ratings business. Look at this massive beat right here. Commodity insights, that's a beat. Mobility, they tapered down the top end of the range to about 8.5, but still largely within the range nonetheless, right? And the indexes business beating by a wide margin as well. So nothing to see here, guys. It's literally business as usual for SPGI. You can go through this earnings report all you want, and all you'll find is a company just acting as usual, business as usual for the company, right? So extremely high quality company, guys. No secret there. It's just business as usual for them. So in terms of the valuation right now for SPGI, well, let's have a look. Well, we have a revenue growth here of about 7% per year, very healthy, but then again, it is a very mature company, so you cannot expect them to be growing at 15, 20% per year. They're not really a growth stock. EPS growth of 13.5% per year, that's very, very healthy. Forward PE at 493 is a 33.26. Now, if you pull that up, guys, you will see that largely, it is the historical average. This is the trailing PE ratio, and you can see trailing basis, it's close to 50. But on a forward basis, as I derived it, it's only a 33.26, which is their average. You can go back in time here and you can see SPGI usually trades in the high 20s to low 30s. So 33 on the forward basis, it's roughly in line. In terms of the PEG ratio at 493, it's a 2.46. It is high, but I said that this is okay for SPGI. You will come across this a lot of times. You'll come across it with Microsoft. You'll come across it with Visa. You'll come across it with MasterCard. When companies have almost de facto monopolies and the revenue streams and EPS streams are highly predictable, well, Wall Street tends to give them a higher valuation because they are such a predictable company. One earnings report is not going to change the direction of the business. Wall Street knows that for the most part, this business will continue to run in any market environment whatsoever. And the free cash flow yield down here at about 3.3%, about the midpoint, right? I was saying before with UPS, I look between 2.5 and 5%. This is roughly at the midpoint right here, so it's okay. So right now, the company is not cheap. It's not expensive in my humble opinion. It's kind of just okay. Now, I'll reiterate the analyst price targets for next year are a lot higher. This company, that's all it does. It just grinds and grinds and grinds higher. It had a pullback with the overall market in 2022, but since then, it's just grinded and grinded and grinded higher, which is why I think that, in my humble opinion, these monthly higher low retests of prior levels are great opportunities either for swing trades or to add to a long-term portfolio, guys. So in my opinion, SPGI, quality, solid company. It's something you can put in your portfolio and forget about it for the next 10 to 15 years. You don't need to worry about earnings. You don't need to worry about cyclicality. You really don't need to worry about nothing. It's just business as usual. They just collect fees, sell data. They have hugely high profit margins. You literally have almost nothing to worry about, similar to a Visa or a MasterCard. Very, very difficult to come in and challenge this company's extremely wide moat. So that being said, I love this one, guys. I'm waiting for it, patiently waiting for it. It's almost ready. If we come back down 477 to 455, I will be picking up a few shares and maybe even some call debit spreads for a swing trade. But keep in mind, this isn't NVIDIA, right? It doesn't move very, very aggressively. The moves are just a grind higher, right? They don't explode for the most part. You can get some sometimes, but for the most part, the rallies look like this. So when you do take some options on them, you got to figure that you have to put a little bit more time and be a little bit more conservative with your final price targets. But that is the analysis on SPGI. Hopefully you guys appreciated that. Now let's dive right back into our technical analysis of our major market indexes, shall we? So moving into the S&P, up 0.22%, but we know that we're now in a daily downtrend, right? So we had the daily uptrend back here. We just recently lost the higher lows in the past few days, and now we are still struggling a little bit. The bulls have not recaptured the hourly trend change just yet, so we cannot say that the daily higher lows are set with the lows of yesterday. We could very well drift a little bit lower into tomorrow's price action, and I would not be surprised to say the least, right? If you want to know when the daily time frame has bottomed, you need to see the bulls recapture the hourly time frame, and then you measure the size of the bounce on the daily to figure out if the bulls can V-shape this, or if the bounce is too weak before losing the hourly to the downtrend again, then we just roll over, probably retest the lows, and maybe even roll over a little bit further. So let's take it in terms of a bearish view right now. If we continue the rollover into next week, into big tech earnings, and we get the absolute flush because Amazon, Google, Apple, everybody misses, let's say, right? Or they do good, but the market just doesn't have it. And we go into further weekly consolidation. Well, is it that bad of a thing, guys? Who's in control here? The weekly bulls, anything above 540, looking for a weekly higher low for further trend continuation. So I still maintain I would be a little bit cautious at these all-time highs, considering big tech earnings next week. Definitely not the time to YOLO chase your favorite names that are possibly close to all-time highs right now. The last thing you want to do, especially in an earnings cycle, also with election uncertainty coming up, we have a rate cut decision come the first week of November as well. So there's still a lot of uncertainty. It may not feel like it right now, but there still is a lot of uncertainty in the markets right now. The recession narrative is on the back burner for now, but we know that any piece of negative data can reignite the recession narrative in the snap of a finger, just like that. So the last thing you want, guys, is to get trapped on some stocks that are at their all-time highs while SPY and QQQ are closer to their all-time highs. You get trapped in the stock. The market has, a 5-7% pullback. You're trapped, and now you have no more money to go shopping for actual stocks that are on very nice dips. So be careful with your positioning right now, and especially your position sizing, right? Let the market come to you is my best piece of non-financial advice, I guess, right? So moving on to QQQs right now. QQQs, same concept. Daily downtrend is underway for QQQs, and they still, even with Tesla's rally, they have not yet changed the hourly uptrend. Need to see that confirmed hourly uptrend breakout. Then we can say the daily lows are set with the lows of yesterday, and we're looking for the size of the bounce. Tomorrow, if the market is bearish, we can very easily roll this one down ever so further, and I would not be surprised to say the least, because we do not have that confirmed hourly uptrend, right? So moving on further, in the event we roll over a little bit more, guys, what are we looking for? Looking for further weekly consolidation. It's now been about 2 weeks of weekly consolidation, 1.5 weeks if you want to be specific, and the higher low area could come in right down here, 482 down to about 475. That is your previous horizontal resistance, should be newfound support, and the 12 EMA is even sitting right there. Even if we cut this area right there, guys, a lot of space, anything above 448, just looking for a weekly higher low for further trend continuation. You see, they do it all the time. We can touch the 26 EMA as well. We touch this 26 EMA and bounce from it and be just fine, just because we have so much space. So no red flags just yet. Moving on to XLF financials. Financials just kind of holding steady where they are. We know the context is a beautiful daily uptrend, looking for the daily higher lows to go for the continuation of the daily uptrend. However, the last 3 days, we have been stuck. No new hourly uptrends, no real hourly downtrend flushes either, maintaining the lows. So we're just basically consolidating sideways at this point. Now, in the event they fail and flush these levels, right, then you will end up in a daily downtrend for the XLF. And at that point, guys, you guys know the drill. Daily downtrend, what does that mean? It means we're going for a little bit of weekly consolidation. And at this point, who's in control, guys? Well, you guessed it, right? The weekly bulls are in control. Any pullback at this point looking for a weekly higher low anything above 44.60 weekly, higher low for possible further trend continuation. And this is one of my favorite trades. Breakout, retest, and possibly run. Could be a swing trade right here. The 12 EMA is also curling into that region, so watch out when that happens. But as you know on the channel, guys, we'll take this one day at a time, and I'll let you know if ever I open up any trades right there. But my favorite one right now in all of financials, has to be said, is Berkshire. Berkshire has been kind of coiling here for about a month and a bit, but who's in control of the longer time frames? The bulls control the monthly time frames. This is monthly consolidation right now. The bulls also control the weekly, but now we're kind of doing exactly what we did back here, right? Some kind of sideways tightening range accumulation. So I like building a position on Berkshire right here because we have a bullish lean, because we know the longer term monthly bulls are here to back us up. So a little bit of a swing trade on Berkshire, using these lows as our guide pretty much to build into the positions. I would not be opposed to. As a matter of fact, I already have started a position on it. Moving into healthcare right now. Healthcare, probably the loss leader of the past, 2, 3, 4 weeks at this point in time. We knew we had the daily downtrend back here. We had a chance, a glimmer of hope for an engulfing move to be able to set up for the daily trend change. They did not get it done. Daily downtrend rollover, and we even flushed the support zone down here, 151 to 150. So at this point in time, guys, daily bears remain in full control of this trade. Daily downtrend remains, and your weekly downtrend remains as well. Where are we probably going to, guys? This line right here. Let's call it, what's actually not a line, it's more of a zone. You guys know I love to draw the zones, right? So let's draw out the zone real quick, shall we? Let's remove this line and let's make it a zone. So what is in the zone? Well, we have a ton of price action from the past. From the past here, a little touch right here. We also have the 50 weekly moving average as well. So that will probably be the likely next area of very large support for the weekly bulls, talking about 148 down to about 145. Now, what are we looking for here, guys? Monthly time frame analysis. Looking for the monthly higher lows for further trend continuation. Horizontal resistance is now going to be support, and the 12 EMA on the monthly is there as well. So healthcare, I wouldn't be too concerned. Two of my favorite plays that I've been bringing up on the channel are going to be UNH. If UNH gives me another monthly back test of the range, talking about 550 down about 526, decent little time to be building a little bit of a swing trade for follow through on UNH. And also another one of my favorite healthcare companies is following the exact same pattern. AbbVie. If AbbVie gives us the good old breakout retest of this range, call it 183 down to about 175. This whole range coming down to the monthly 12 EMA could be a decent little swing trade as we continue to see weakness in the healthcare sector. But notice how I said weakness in the sector, but these two names are some of the names that have not been coming down as much as the sector. They are, in my humble opinion, two of the sector's lead bulls still, even though everything has been pulling back in healthcare. Moving on to SMH. SMH not looking too bad today, but a bit of a sideways day for SMH as well. We're not really breaking any levels to speak of. Daily uptrend is the context right now. Higher lows are set. Then, unfortunately, they put in the lower high and now the equal lows. So we have a bit of a tightening range going on right now. If you flush the lows of last week and also of yesterday, because they're equal lows right there, if you flush them right there, daily downtrend is definitely underway. And then we just look for a little bit of weekly pullback, because right now we know the bulls are being challenged by this overhead area of resistance, right? Resistance, support right here. And then we kind of unraveled resistance, resistance, and resistance. So that is what we're currently battling with right now. If we unravel and set up the daily downtrend further, once again, just looking for a higher low on the weekly, anything above 213 weekly, higher low for possible further trend continuation. I would target this zone down here, 238 down about 231. And if we come down there, a lot of your favorite semiconductor names will be in weekly pullbacks at that point. And the way that I love playing them the most to benefit from the volatility in the semiconductor industry right now is by playing the good old short puts using the wheel strategy. So hopefully that makes sense for semiconductors. We'll take this one day at a time. And obviously, guys, if the bulls convert this, well, daily uptrend is just resumed. Your weekly higher lows are set. And we just go for another weekly leg higher. Next resistance is going to be the all-time highs. Now moving into the Russell. So the Russell up about 0.22%, but not doing a whole lot of anything, right? We know the context right now was the bulls had a very nice engulfing move. They created a lot of space to maybe set up the daily higher lows and make a second or third or fourth or fifth attempt, depending on how many times you measure, right? At this big resistance zone, which is the highs from 2020 and 2021. But couldn't get it done, and we gave back a lot of the move. So it stands to argue, guys, when the bulls lose that much momentum, the bears take back 80% of the move, it's going to be very hard for the bulls to have the strength to fully V-shape this, but not only V-shape that move, but also not only V-shape, smash through a 2-year range of resistance in one clean shot, which is why I say the best case scenario now, maybe for the bulls, just might be a tightening range at best. Tighten up a little bit, build up that momentum, and then you go for a swing. Starting the swing from down here, you may just run out of strength before you get through this zone, right? Now, the worst case scenario, obviously, is the lower high, lower low rollover, daily downtrend rollover, and just extended weekly consolidation. We know this has been somewhat of a ascending tightening range right now. It looks pretty good for some follow through on the longer term timeframes. I'll give you that, right? But the market needs to cooperate, and I think we really need to get through those big tech earnings that are coming next week as well. So the Russell for me still remains a little bit of a mixed trade. I would be interested if we revisit the 214 down to 208, build a little bit of a position here. But at this point, guys, the risk reward, unless you have a very long-term time horizon, if we're looking for a swing trade, the risk reward is equidistant, right? Our risk is down here and our reward is up here. It's basically a 1-to-1. We have equidistant space. Moving into the Dow Jones, and once again, give me another brief second. All right, perfect. So the Dow Jones down about 0.33% today, and the Dow Jones now embarking on its own daily downtrend. So we knew that was the case after yesterday's flush. Daily downtrend underway. Not that big of a deal though, guys. Why? Because our longer term timeframes are always the guide. Weekly is in a beautiful weekly uptrend right now, looking after 6 weeks of rise, looking for a very healthy technical pullback, looking for a higher low. Anything at this point above 40,000, just gonna be looking for a higher low for possible further trend continuation. A few things lining up right here. I put a yellow line right here. If we extend that, you'll see it kind of lines up with the weekly 12 EMA, which is curling there. And it is your previous area of former support through the early portion of October, about 2-3 weeks of price action right there. So that's going to be level number 1. And if we blast through that one, well, there's an even bigger one down here around the 41.5. And that is where I think it will be the final stop for the bears in the event that we really get an extended sell-off in the markets here. So that's pretty much everything for the Dow Jones. In terms of yields and in terms of Bitcoin, gold, and oil, we'll recap those all tomorrow when we can spend a little bit more time on this. But now, just for the sake of preserving time, Bitcoin we also did yesterday, so we'll keep that on pause. Now we'll jump right into our big tech names. So I'll do all the rest tomorrow, guys. Full recap tomorrow. But for the sake of saving time right now, since we did some earnings, I'll kind of cover these right now. So Apple, not looking the worst, right? 0.08% to the downside, putting a stop to the bleeding. And that's what I was saying, guys. A close below 227, roughly 227.50, would invalidate the breakout retest setup. As of right now, it is still in play, but barely in play, but the bulls did keep it in play. We never lost with a daily close. We never lost at 232 down to about 228 level. The invalidation level is slightly below here if you have any swing trades for this one, right? So still not looking too bad for the possible daily uptrend shift to the bulls right there. But keep in mind, Apple has earnings next Thursday. So not that many days of price action for Apple. In terms of the weekly is also not looking too bad. It kind of looks like the Russell at this point, right? So at this point, guys, weekly uptrend is in motion. We're looking for, once again, as we have the daily consolidation underway, right? Loss of the daily uptrend into daily downtrend right there, little bit. So if you want to analyze this, right, it was a daily uptrend. We lost at the flush. So higher high, low, lower high, lower low. So now we have the daily downtrend, a little bit of weekly consolidation. If we lose this level and dive a little bit more prior to earnings, it will just be more weekly consolidation. And then earnings, Apple usually moves about 4% on the day of earnings or slightly after. So we'll see how they can move, guys. 4% in either direction. Well, 4%, if we maintain this range, 4% to the upside would be a new all-time high, and 4% to the downside would lead us into my preferred range that I would like to play the stock in the future, 219 down to about 215. I wouldn't mind playing it, guys, but I'm not going to be doing it too aggressively just because the valuation of Apple right now is very high. There's some concerns about slower than expected iPhone 16 sales. And just, I haven't really felt, Apple's a very wide business, of course. Their services business is doing absolutely amazing. Tons of lines of businesses are doing amazing. But the one that counts the most, obviously, in people's eyes is the iPhone, right? So I'm very curious to see how those sales do. So for now, I would not mind taking a little bit of a swing trade here, but it wouldn't be my preferred stock to do it on. But if it comes down there and the conditions are met, I could add it to the list. Now moving on to AMD not looking too bad either, 0.35% to the downside. But we know that the context, guys, has been this extended daily downtrend that we've been in. The bulls are trying their best to protect this 200-day moving average, which is the green line right here. However, we did lose the big area of support, guys, 162 down to 153. We've been saying it on the channel for a while, right? Huge support in the past. Congestion, support, and resistance at one point. Resistance, so you guys get the drill, right? Very large congested area, and unfortunately now we are below it, so it becomes resistance once again. So daily downtrend remains underway at this point. Now, the bulls still have not, guys, they still have not gotten the hourly trend change back. As a matter of fact, if we turn on the regular trading hours, not extended, you'll see that even better. No change in the hourly trend, so we cannot say that the daily lows are set. If they do that tomorrow, higher high into tomorrow, break today's high, perfect. We can say the daily higher lows are set, and then we measure the size of the bounce in relation to this guy right here, which is your most recent lower high, right? So we need to measure the size of the bounce, looking for a 50 to 60% bounce at the best. And then that sets us up with some space to create a new daily uptrend and start moving through this area of resistance. However, all that's fine and good, but it's not really going to matter because the earnings are on next Tuesday. So I don't know if we'll have the time to kind of complete a little bit of this pattern before earnings, but AMD earnings usually move about 7-8% either direction. So 7% to the downside would put us right back down to my preferred area to be writing short puts, buying some shares, taking a little bit of a risk with some call options. Down here, 140 to 125. This is the bigger support zone that I would like to play AMD. And obviously, if they smash it to the upside, 7% to the upside, well, we would finally get through this resistance area again. The bulls would finally complete the weekly higher low pattern right there because we are in a weekly uptrend. We would be above, and then we'd be looking on the daily for a little bit of a retest trade, touch this zone as support, use it, and then get a new daily uptrend going. So we'll see how things go with AMD, guys. I'm hesitant to play it before earnings. I'll probably wait until after earnings to play this one, but those are the two different trades that we can expect after earnings, right? One would be down here, and one would possibly be the breakout, retest, use this zone as support, and possibly run. Moving on to Amazon right now. So Amazon up about 0.9%, not looking the worst, especially after yesterday's decline, but fact of the matter is we did lose the daily uptrend into daily downtrend at this point, and resistance is still set above 190 to about 187. Amazon as well has earnings next Thursday, so very difficult to say whether or not they can get through this prior to earnings or whether or not we just kind of drift sideways in or around the current pricing zone. So one thing's for sure, in terms of the weekly, not looking too bad. We have a weekly uptrend, which is nice right now. And now we've been kind of trapped between two levels, right? Let me just zoom in a little bit. Trapped between the whole 190, 187 area of resistance for the past 5-6 weeks, and to the downside, the 180 to 178. The expected move for earnings on Amazon is roughly always about 5%. It can obviously go more or less, but let's say it just goes 5%. 5% to the upside takes us right back up towards the all-time highs, smashes through this area, really gives the bulls some lift and continuation for this weekly uptrend momentum. And in the event we get hit with a 5% downside flush, like happened here as well, that's going to open up some extremely nice buying opportunities, in my opinion, guys. Let's say we drop from here, it'll bring us back down into the mid 170s. The 200-day moving average is right there. The big area of support. This area of support, guys, is massive. It's the previous all-time highs from 2020 and 2021. You think the bears are going to get through that? Probably not very easily, right? So if we come down here, this is leap call territory, in my opinion. 175, 170, I will be buying leaps on this one and going pretty heavy because I think Amazon's going to have a great rest of the year, but also a beautiful 2025 and 2026 as well. Moving into Google. Google flat on the day, and nothing is happening with Google at this point, right? I was talking about this yesterday. We have been trapped in this range now, this little tightening range that they have right here for pretty much the past, month at this point in time, right? So no breaks whatsoever. The price action is kind of fairly messy. No daily uptrend, no daily downtrend as of yet. So it stands to argue if we break it to the downside, daily downtrend is well underway. If we break it to the upside, daily uptrend is underway. But until that time, it's very muted. They have earnings on Tuesday, guys. So I expect it to remain muted until the Tuesday for earnings. Now, Google usually also moves about 5-6% after earnings. So one of two things is going to happen, right? If we drop to the downside 5-6%, we're going to end up in my favorite area for buying leap call options, and I will be adding a lot more to them. And even writing short puts down here is a great opportunity to farm some income, because Google right now, the valuation of Google is extremely cheap, guys. 1.1, 1.2 peg, cannot go wrong with that. And the company is doing absolutely amazing. I haven't done this in a while, but I always make the case for Google, right? All the analyst price targets are above the stock. Everybody is either a hold or a buy. Look at this EPS expansion for the next 4 years, and look at this revenue expansion for the next 3.5 years as well. Looking absolutely fantastic. No problems with the company. It's just been plagued. The Department of Justice headlines, people talking about Google's going to split up the company, stuff like that, right? All of that for now is simply just speculation, even though the DOJ did win in a monopoly and a monopoly case against Google, saying that their search business is a de facto monopoly. Well, the resolution by the DOJ still has not been given. So, if they can't even give the resolution on that, they still have to argue whether or not the advertising business is a monopoly, and then they have to argue what's the resolution for that. Breaking up the company is like the last thing on the list, right? So I don't think there's very real risk of that happening. But once again, we can't say the risk is zero, right? We have to acknowledge the risk. And as a Google investor, I acknowledge the risk and I'm willing to take that risk. So to the upside though, if we break 5-6% to the upside, well, very simply guys, we will be smashing through this area. Well, that's 9. We'll be coming through this big area of resistance that's been plaguing us. And keep in mind, the daily inverse head and shoulders could be popping up to the upside, coming into resistance at that point, probably just looking maybe get stopped out right here in terms of momentum, right? Waning momentum, give us the retest trade, and then try this one again. So those are 2 trade styles I'll be looking at for Google in either case scenario. Moving on to Meta right now. Meta continues its consolidation, but it doesn't look like it, right? 0.73% to the upside inside yesterday's candle. So unfortunately, it is still a daily downtrend for Meta. If Meta sets the lower high into lower low, continuing the daily downtrend, we know what we're looking for here, guys. We're just looking for the weekly higher low for possible further trend continuation. So I've been talking about this one for a while. If we come back down and retest 545, 530-ish, breakout retest trade, I will be sitting here waiting for some Meta shares and even some call options to play that next leg higher. The valuation for Meta, we did it at 600 just to prove a point, was still extremely cheap on a PEG ratio basis. And at 600, even the free cash flow yield was still above 4. Absolutely fantastic fundamentals for this company. And once again, they have earnings coming up next Wednesday. So everybody reporting next week. It's going to be a heck of a big week, guys. So if we come down back to here after earnings, I'm a big fan. And obviously, if we blast off, guys, well, then we're just going to have to wait for the breakout, retest, and run a little bit further trades. So those are the 2 types of trades I'll be looking for Meta. But as of now, just holding my long-term shares. Moving into Microsoft. Microsoft trying its best to defend right now, but Microsoft is coming into a crucial turning point, and they have their earnings coming up next Wednesday as well. It's going to be a huge week next week, guys, right? Daily uptrend is underway by Microsoft. We knew that it was a struggle for them for a very long time, right? 2-3 weeks of downwards price action. Now they have secured, after sideways consolidation, they've secured a new daily uptrend. They have also secured the short-term moving averages, but not with that much wiggle room. And unfortunately, we're setting this area of uptrend into a big area of resistance. 435 down to about 424. We know it's plagued us many times so far over the course of the year, right? So that being said, if Microsoft is unable to break through this zone by the time they have their earnings, well, we can expect them possibly to do it after their earnings. Microsoft usually moves about 4 or 5% on their earnings as well. So 4 or 5% to the downside, 5% would take us right down into our juicy area of support, guys. It's been support all year so far in 2024 as the company has been improving its fundamentals ever since. Now, if we come down here, this is going to be leap call territory for me. I already fired one off at about 414, 415. I will be adding 1 or 2 more if we do come down into that lower location. And in the event that we blast off higher, well, it'll be good for us because at that point in time, we will be now above the resistance area, probably tapping into the 440s, and then we could do the breakout retest trade, right? Break out of the zone, possibly retest the top end of it, and possibly enter for a new swing trade using this whole previous resistance zone as current support. So those are the 2 types of trades we're going to be looking at. Microsoft really teetering. It has the weekly uptrend momentum, but can it follow through after earnings? That is what we will see. Now, moving on to Netflix. Netflix up about 0.7%. Netflix still trying to find its post-earnings bottom right now. So we know that the bulls are in full absolute control. New all-time highs were set earlier on in the week. And now we're just trying to go for a little bit of daily consolidation. Anything above 678, looking for a daily higher low for possible further trend continuation. So there could be a little bit of a breakout, retest and run trade here. If we drop a little bit more, 738, 730 could be a decent little entry opportunity. Who's in control right here? The weekly bulls are in absolute full control. This is something I was explaining to one of my students, so we'll leave that away. Now, weekly full bull control, looking very good there. The monthly full bull control as well. So at this point in time, guys, the next area of resistance, you have to go with psychological numbers. You can say, yeah, it's the previous high, but if we do get that next leg higher, guys, $800 is going to be your psychological target of resistance at this point. And even the peg at 715, when we did it, guys, after earnings, before they rose even more, the peg wasn't so bad at about 1.6, and the company is growing revenue and expanding EPS in a very, very nice fashion. So I love holding Netflix in my longer term portfolio. No signs of me wanting to sell it anytime soon. Moving on to NVIDIA right now. So NVIDIA up about 0.61%. Really hasn't done much since the Monday session, right? Monday was really the outperformance day. Just been consolidating in a very healthy way. Daily uptrend is clear as day on NVIDIA right now. Just looking for a higher low at this point. Anything above 129, going to be looking for a daily higher low for possible further trend continuation. They're kind of using, I mean, we can put a line right here. You can see what they're kind of using, right? They're kind of using the prior all-time highs. Not quite, but you guys get the idea, right? There is a tiny little level they're trying to respect right there. The 12 EMA is also right here too. In the event we give back too much and open up the door for the daily downtrend, you must understand who's in control of the weekly here. Weekly bulls are in full control of this chart, guys. Any extended pullback going to be looking for a weekly higher low. Anything above 102 is going to be that higher low. First area of support down here, 130 down to 126. The weekly 12 EMA is right there as well. And a bit below that, the area that I would be tempted to play this one a bit heavier would be 120 down to 115. That will be for a bit more extended pullback, right? So that's pretty much everything for NVIDIA. Nothing much to see here. Bulls remain in absolute full control, but of course, very tough for us to buy it up here for some continuation. The risk reward is not in our favor. I'm not saying that you can't make money. It's just in terms of pure risk reward, objective fashion, taking off the bullish NVIDIA goggles that I have as well, right? There's not much risk reward here, right? Last thing you want to do is get trapped here. The markets have a bit of a 4, 5, 6% pullback. NVIDIA pulls down to the 125, 120, and then you have no money to actually buy it where you truly wanted to in the event you exercise a little bit more patience. Moving into Tesla. Tesla, of course, the big winner of the day, up about 22%. We covered their earnings on the channel yesterday. I spent a very long time on it yesterday because, it just had to be said that Tesla is probably right now, the worst is probably, and I say this word with quotations, right? Probably, because anything can happen, of course, right? The worst is probably behind the company in terms of the macroeconomic environment that they were facing earlier this year and even end of 2023. We are now in a much better outlook for the foreseeable future in terms of a rate cut environment, in terms of Tesla's net margins expanding once again, in terms of the possible vehicle ramp of a more affordable product for mass production purposes, in terms of selling a vehicle between the range of $20,000 to $30,000 type of thing, though that is all slated to happen in 2025. So we're closer to the next positive catalyst than we are to all the negativity that was back here, right? So I know that Tesla is a very polarizing company. I've said it before, right? I'm a Tesla investor, but I never force the company on any of you guys. You guys are free to have the opinions that you want. I know Tesla is very polarizing as a company for a few reasons, just because of what it does, but also because of who is the CEO of the company too, right? And that's perfectly normal. You either love the company or you hate the company. I'm just here to report the technical analysis and the earnings numbers, right? So into the technical analysis, 22% to the upside, definitely one of Tesla's best days in recent memory. I have not really seen a 20+% day on Tesla, admittedly, since the rally in 2020 and 2021, right? We haven't seen these. We've seen 10% days, back-to-back 10% days sometimes, but not a one single 20% day. So it seems to be some renewed optimism in the company. That being said, we need to understand where we are in location. Location right now is very important. We are coming into a very large area of resistance, 260 to about 270. You can see that this area has plagued Tesla for a very long amount of time, right? Ever since the late fall of 2023, 265 has been a very tough level to kind of break above. And once we do get above that, then of course the next level is that 300 psychological, which proved problematic for Tesla a few times in its past as well. But first things first, we need to get through this one. In the event the bulls fail, well, now obviously we have a ton of space, right? At this point, anything above 213 will just be searching to set up for a daily higher low for a possible second attempt at smashing through this 260, 270. The bulls on the daily right now are in full control. And if and when we drop, because there's a chance they can just blast through this and go to 300. But in terms of the probabilities, it does favor a little bit of a momentum swing from bullish to a little bit of take profit action, encountering the resistance, losing a bit of momentum. Daily higher lows can be set. 245 down to about 235 is the expected range, coming back into support before we can maybe have another little stab at a bit of a rally on Tesla. But as of right now, the bulls are looking very strong. The weekly candle, if they close like this, is going to look very bullish for some continuation into the next few weeks. They never lost the weekly uptrend, guys. The weekly higher low is right here, 202. And this is what we were watching for after the robo-taxi event. Were they going to lose 202 and lose the entire weekly uptrend? They did not. The weekly higher lows are now set at about 213. They came close, but they did not lose them. So this is still a weekly confirmed uptrend. It's not the prettiest because of these massive swings right here, but it is a confirmed weekly uptrend. So we'll be looking, can they break this? Or will we just possibly pull back and consolidate a little bit more before making a second attempt at breaking it? So congratulations to all the Tesla bulls out there. Congratulations to anybody who played options to the upside. You must have some very juicy premiums, very juicy gains today. So happy for all of you guys. But that is the way that I see Tesla in terms of the price action for the chart. If you want a full breakdown of their earnings, just go to yesterday's video, and the timestamp to it is down below in the video description. Spent about 15-20 minutes on it. Did a very, very large recap, right? Now moving into Palantir lastly, up about 2.28%, guys, and Palantir looks like it's ready for another leg, right? So daily uptrend is clear as day right now, looking fairly good. Daily higher lows are set, and just looking for a new leg up. The resistance point is obviously going to be the previous highs right here, 44.36. And if they cannot get it done, guys, if they fail and roll over and flush the higher low, 40.37, daily downtrend is underway. And at that point, we'll just be going for a little bit of very healthy weekly consolidation, guys. At this point, weekly uptrend is beautiful. Looking for a weekly higher low. At this point, anything above 29.50. Just looking for a weekly higher low for further trend continuation if they roll over. But now the bulls are in absolute full control. But if we do roll over in the next few weeks, let's say, if we come down 39.38, I'll be looking to write some short puts, possibly in the 36.35 location, just trying to find the weekly higher low before maybe another leg of increase into Q4 and maybe into Q1 of next year. So that's pretty much everything, guys, in terms of the price action for today. Now, in terms of the trades, I'll only give you guys the updated trades that we made over the course of the day today. In terms of a full portfolio recap, you guys know the drill. Usually I do those on Friday. So let's go through a few of the trades that maybe you didn't see, right? Since we last did the last update on Tuesday. So I'll update you on a few of the wheel trades. So you guys saw the Chewy trade that I opened and closed pretty much within the one day, but you did not see the Coca-Cola trade after earnings. Coca-Cola after earnings, we were able to find the 66 strike. We got 25 cents for them, and we closed them the exact same afternoon because Coca-Cola doesn't have that much premium, guys. These were for November the 1st, the following Friday. So we wrote these yesterday on the Wednesday session. We wrote them when Coca-Cola was arguably at some of the lows of yesterday morning in this location right down here on the little pullback, right? And then, or sorry, was this pullback right here? One of the two, right? You'd have to go back to the timestamp. I'm sure the timestamp is actually in the Discord right there. So there you go, 9:52 a.m., right? So right around here. We got the low of the day, closed it in the afternoon after the big rally right here. Got 50% profit, guys. I'm not going to hold a contract for one remaining week when we already have 50% profit the same day. Why would I hold the remaining 50% for an entire week? I'd rather take that $6,600 in exposure and go find another play, right? So that is pretty much everything for the Coca-Cola play. The ELF play is still running right now. You guys know we showed this one. It's almost worthless. ELF is right now at about 106, 107. We'll see if we get a sign tomorrow, but those should be good right now. We also had the ON Semiconductor play that we opened earlier on in the week. I showed you this last Friday and also on the Tuesday recap. Then you had the 64 puts for 33 cents. We closed them at 3 cents today, 90+% profit, just closing some gains, freeing up some buying power in case we open up some opportunities. Another wheel play that I did not show you guys because we opened it yesterday is sometimes what I like to do, the more advanced wheel strategy, where I write longer dated puts on a big drop, daily oversold, because then when we get a bounce, we can pull forward a lot of that premium and close the contract a lot sooner than expected. So Enphase, after their earnings, first thing in the morning, guys, 3 minutes after the open, we wrote the November 29th, so about 38 days out. November 29, $70 puts, which was at that point about 10% away. Enphase was about 78, 77. I'll show you guys on the chart just so you understand what I mean. So Enphase, we were looking for this play after earnings. We wrote the puts all the way down here, right at the market open, right? When volatility was high, and we had a very, very decent wide margin of error. $70 was going to be the strike down into this big, big, big area of previous support, right? This one down here. From all the way back in 2020, the lower end of this range, right, at the start of it, right, $70, and we got a decent amount of premium for them, $3.10. So as a whole, that was about 0.7% per week. You guys know I always look for about 0.5% per week. So this one was about 0.7% every single week. And you can see, guys, we closed them today. After 1 day of being an Enphase, nice little rally, we closed them at $1.90, 40% of the contract value pulled forward in one single day. And I gave the calculation right here. Feel free to pause, right? You do the remaining amount of premium divided by the strike, divided by the amount of weeks, and it only gives us about a 0.45% per week ROI. That is under our 0.5% rule. So it stands to argue, guys, if I can realize 40, 50% of a contract in 2 days, and there's 6 weeks worth of remaining time, should I wait the additional 6 weeks to collect the other 50%, or should I just take the 7,000 in exposure and find another trade that does respect our weekly minimums? Well, we always cycle the trade away, and that is pretty much it. So those are a few of the closing trades that we made today. Some of the other closing trades that we made today, happy to say that we closed a bunch of our swing trades in shares. EVVTY, you guys remember me opening this one about a week ago at the $90 range? Right here was the trade order right here, 91.05. Sorry, my broker logged out again, so I'll just do it from the Discord. So you can see EVVTY filled at about $91. I gave the full analysis in the Discord, but I told you guys on the YouTube as well. We closed them for a decent profit. Half close though, 50% partial close, 13% in 1 week. EVVTY had earnings today, and I was telling you guys that this one was significantly undervalued in my humble opinion and coming into a gorgeous area of technical support, the lower 90s. So respected my rules, stuck to the plan, took the trade, and was handsomely rewarded. Closed half of the trade today in our designated area of resistance. And the next target remains the 111. So that is the next area that I'll close the following batch for that trade. And the second trade that we did close as well is Louis Vuitton. We bought the lows of the earnings on this one. We bought them at 128. You guys saw me do that on the channel as well. Here's the trade, 128. We bought those on, October 15th, all the way back there. And now Louis Vuitton closed them for 137.15, 7.1% ROI in 8 days. Louis Vuitton was a very, very simple trade, oversold conditions on a very high quality stock, coming into a very large area of support as we saw back here. They hit daily oversold during their earnings. During their earnings release, they were actually hourly deeply oversold in the low 20s. So took the trade down here at about the 120 to 128, and we closed them right up here, free up a little bit of capital. I was supposed to close them in 2 batches. It's my mistake. I was on the live stream this morning, and I was supposed to close only half the position and let the other half ride up to about the 150 range. Unfortunately, mistakenly, I closed the full position. That's just what it is, but still happy with the way that one went. 7% in just about a week of trading, guys. Can't be mad at that. So those are just a few of the trades. There's a couple more that I'll show you guys tomorrow in the full portfolio recap, but just to show you guys that we've been making a decent amount of premium and also a decent amount on those swing trades over the course of this week so far. So that's pretty much it for today's video, guys. Hopefully you appreciated that. If you appreciated the video, consider dropping a like. Would really enjoy it for the growth of the channel. Also consider subscribing to the channel if you're new. We do these videos every Monday through Friday after the close. Hopefully to see you back soon. And lastly, guys, if you have any questions at all, please feel free to leave them down below in the comment section. You guys know me. I usually always answer within the first 24 hours. Anything you want me to look at a specific stock, technical analysis, second opinion on a swing trade without it being financial advice, of course, macroeconomic discussion, anything you guys want is always up for a question, so leave it down below. And in the event you want to join the Discord and get all of those trades that I just showed you in real time, have access to our private morning live streams where you can see me trade live, ask me questions, have access to of course, the private videos that we do, and have access to the chat room where you guys can ask me any and all of your questions all throughout the day. The link to the Discord is always down below, so feel free to check it out if it's something that interests you. So that's pretty much it for me, guys. Take care. Happy Friday tomorrow, and I'll see you tomorrow after the close. Peace.